Imagine getting paid for owning an investment. That sounds great, doesn't it? And that is the promise of dividend investing, but is it really the best way to build wealth? If it were so easy to get rich and create passive income with dividends, then why is not everyone doing that? And that is one of the questions I want to answer in this video. And I also want to make this video a whole guide about dividend investing for you. So I'm going to walk you through how dividend investing works, the pros and cons of dividend investing, and who it's really for. So that by the end of this video, you can decide for yourself if this investment strategy really fits your financial goals. So if you want to start investing and you can't really decide on a strategy, or you already are investing and you're looking for alternative strategies, then this video will be for you. And it's actually the second part of a series I'm creating about investment strategies, because I want to make your journey to building wealth easier and faster. I will link the playlist down below, and of course you can also consider subscribing if you don't want to miss the next one. Also, in case you're already familiar with dividend investing, feel free to skip to the sections that are relevant for you. I created timestamps. If we haven't met, I'm Sophia. I've been learning about money and investing for the past decade. And here we explore the strategies how to build wealth without living frugal. And now, without any further ado, let's dive in. What is dividend investing? A dividend is money paid from a company to their shareholders, and that money is part of their profit. Let me do that for you. So I hope this is big enough for you to see, but we have a company and the company has a profit, and then it shares part of that profit with the people owning their stocks, so with their shareholders. Now, dividends are usually paid quarterly, but they can also be paid monthly or half-yearly or yearly. And then dividend investing is when you as a private investor decide to invest into stocks from companies that pay dividends. Keep that in mind, we will need that for later. And the companies that do pay a dividend are usually those big, mature and profitable companies, usually for consumer goods or utilities. Random examples for this would be 3M and Johnson & Johnson. And now just real quick, before I continue with how dividend investing works, I'm hosting a free web class where I show you the exact strategies, how I build wealth without missing out on the good things in life. It's completely free and you can save your spot, there's a link down below. How dividend investing works is when you decide to start dividend investing, then you have two choices. You can invest into single stocks, or you can invest into funds that bundle together several different single stocks. So how that would look like. Alright, so this is you. You can either buy single stocks, which would mean that you buy the stocks, for example, of this company so that you can become one of their shareholders who gets paid from the company, or you can buy a fund. And what a fund basically is it's a product bundling together several different companies like this. So the advantage of buying a single stock like here is that you keep all the dividends that the company pays for yourself, except for taxes, but that depends on the country you live in. But when you choose this version, you have to choose the company or companies, so the single stocks you're going to buy, and that can be overwhelming. And you will need larger amounts of money to invest into single stocks if you still want to diversify. Because ideally, you don't want to put all of your money into the stock of one single company. Because, and that is another but with buying single stocks, you carry the full risk. So when this company goes bankrupt, your money is gone. And that is right. Even when you go for single stocks, you don't just want to buy the stocks from one company. You want to buy the stocks from several different companies. And now when you buy a fund, that's done automatically for you. Because the very definition of a fund is that they're bundling together several companies. In our case, this will be dividend paying companies. And so when you buy a fund, this will automatically be diversified. Also with this version, you can start with little amounts of money and you still have the full range of diversification and of companies, being represented in that fund. And you also have a lower market risk, because if one company in this fund goes bankrupt, then it just gets replaced by another one. But there is also a but in the fund version, because when you buy a fund, there will be costs. So what you get paid are the dividends minus the costs for the fund. Now I'd say if you'd go for an index fund that is very low in cost, then these costs are like almost negligible, but still that is one aspect to consider if you're going to a fund or for the single stocks. And just in case if you're interested, I personally also invest part of my money into a dividend strategy. I'm doing both. So part of my money goes into single stocks that pay a dividend, and another part of my money, that is allocated for the dividend strategy, goes into a fund. So like always, when it comes to investing, you can also mix and match, so it best fits your needs. All right, and now let's go through some important dividend strategy numbers. We have the dividend yield. The dividend yield is displayed in percent, and it is how much income you earn relative to the stock price. Now, theoretically, for us, the higher the dividend yield, the better, because then we get paid more, right? But a dividend yield that is too high can also be a red flag, because when the company is paying out too much of their money without, using that money to take care of the company, then this can go sideways. I'd say a good range to look for is between 2 and 6%. And then when you can decide between a 2% and a 5%, then I'd probably rather go for the 5%. Then we have the payout ratio that is also displayed in percent. And that is how much a company's profits are paid out in dividends. And I found the number of a safe range being under 60%. Now, I'm going to be honest with you, I do not look at this metric. I'm just mentioning it so that you've heard of it, because I personally think if it were that easy to take one random metric out of 1,000 metrics from a company and use this metric to determine if they're doing a good job or not, that seems a bit too simple for me. And if you then decide, for example, against the company because they have, 62% or 65% payout ratio, then you just might miss out, if you know what I mean. Okay, so another factor that we can look for is the dividend history. And that is the track record of how many years the company has paid out their dividend, and also if they have been stable and or growing over time. And when we look at dividend-paying companies, there is a specific list. They are called dividend aristocrats. And those are companies that have paid out their dividends for 25 years or more of consecutive increases. So they did not increase their dividend payouts. They either stayed stable or they increased it, and that over a time period of 25 years or more. So you may or may not look for that. I personally think if you go for single stocks, then it doesn't hurt to mix some of those companies from this list into your portfolio, just because it adds a little stability. But of course, if you only look at that list of aristocrats, then you're kind of narrowing down your choices of dividend-paying companies. So, when you have all these different companies who pay a dividend, but then you only look at the ones who are at least 25 years old and also have never decreased their dividends and only either kept it stable or increased their dividends, then this is a smaller number, obviously, of companies. And then you might miss other ones who maybe also pay a high dividend, but they're just not as old yet. Are you guys getting this? All right, so that is something to consider when going for single stocks or even going for funds or a combination of the two. All right, another number you can look at is the dividend growth rate. That's also displayed in percent, and that is how consistently a company increases their dividend. So I found a good range of 5 to 10% increase of annual growth over the course of several years. Now, gonna be honest with you again, I do not look at this metric either. And I guess that's for two reasons. One is that I can completely understand if there may be a time where a company goes through a rough patch and then they cannot increase their dividends. And then for me, that would rather be a good sign that they're taking care of themselves first, and then after they're taking care of their shareholders. So that would not automatically be a red flag for me, if you know what I mean. And the other reason, which is rather a personal reason, when I invest into a dividend strategy, the only purpose is that I get paid. And then I don't go look if they're paying me a little bit more or a little bit less. It just matters that money is hitting my bank account, if that makes any sense. Now, a number I would say is definitely relevant for us when we decide to go for a dividend strategy is the dividend frequency. And that is how often per year the dividends get paid out. Like I already mentioned, the most common dividend frequency is quarterly, which means that the dividend gets paid 4 times a year. But there can also be companies who pay out their dividends monthly or who pay them out only twice a year or only once a year. So everything is possible. And that obviously is relevant for us because it's how regularly we're gonna get paid. And if, for example, getting paid quarterly is not enough for you, what you can do is you can again mix and match different companies or different funds that pay out quarterly, but in different times of the quarter. I talk about this in detail in another video. I'll link it down in the video description. A factor that is also relevant for us, not just when it comes to dividend investing, but when it comes to investing in general, are the costs. Now that is not so relevant when you go for single stocks, because there are no running costs of single stocks, just the costs, the transaction costs when you buy them, and maybe again when you sell them, if you decide to do so. But when you go for a fund that bundles together the different single stocks, then you have yearly costs of that fund, and this is the TER, the total expense ratio. And as always, we want to keep this one as low as possible, because the costs diminish our return, in this case our dividend income. But I also want to mention that if a fund has higher costs because, for example, it's a high yield dividend fund, then that would be okay in my opinion, because I also, when I started looking for high dividend yield funds, then the ones with a really high dividend yield are also more expensive than other ones. But just to give you a perspective, this was still less than 0.8% per year. And I would never go for one that costs more than 1%. All right, and now let's talk about the pros of a dividend strategy. Now, ultimately, I would say this is the easiest form of passive income, because you buy the stock or the fund and then you get paid. And that's really all that is. So you sit on the couch, you take your phone, you open your investment account app, and then you buy the stocks, and then the next period, dividend paying period, you get paid. Man, that's awesome. And for me, what I have to say, the major advantage of a dividend strategy is that you don't need to sell your investments to profit. So you have your investment on the one side, this is what you invest, and then you get paid an income, right? So this is how much you invest into your dividend strategy, and then you passively get paid out of that what you invested, and you do not have to touch this investment. So there is a very clear separation of what you invest and your profit. And that is compared to, for example, an index strategy, which means that, what you invest kind of like compounds. So this here becomes bigger, right? So this here is, for example, index investing. So through compounding, so over the year, this gets bigger and bigger and bigger, right? But here you have no clear separation. So you have your, let me call it investment mass. And if you want a profit of this whole thing here, you would have to sell, right? Sell in order to get the dollars. And what I have found for myself is that selling an investment is a bit of a psychological barrier. And that is actually one of the reasons why I jumped onto the dividend strategy, because it's just so easy. You buy, you get paid. And then, by the way, when you get paid your dividend, your income, you have two choices. The first one is you can just use them to cover your costs, and then you can just keep investing until your principal has become so big that it covers all your costs. That is one option. Or the other option would be you could reinvest that money into your either dividend strategy or another strategy that you have. And when you go for this one here, so reinvesting, when you reinvest it, then you also have this compounding effect. So then this also gets bigger and bigger and bigger, because then you don't just have the savings rate of your active income, that you buy the dividend stocks from. You also have the dividend income that you can now also pay stocks from. This is called the snowball effect. Let me write that here. So when you reinvest the dividends, you have the snowball effect, and this gets bigger and bigger. All right. Okay, and now let's get to the cons, or to the trade-off of a dividend strategy. And now remember what I said in the beginning. In order to invest into a dividend strategy, you need to invest into companies that pay out a dividend. And now here's the catch. I already said that the companies who pay out a dividend are usually historically very solid companies. So when we look at those companies who are old and big and solid and profitable, then this is only a relatively small number of companies. So when we look at all the companies, but we only pick out the ones that are old and big and stable and profitable so that they pay out the dividend, then this is maybe these, right? But that also means that when we only do a dividend strategy, that we completely ignore the rest of the companies in the world. Let me take a different color. So we may miss a smaller company that maybe has huge growth potential to someday become a company like this as well, but then we miss all the growth when we just focus on these ones. Do you know what I mean? So it's kind of like when you're cooking a vegetable dish and you take a handful of different vegetables, but then you forget or you dismiss the herbs and the spices. And you can still have a very delicious dish, but you also may be missing out on a lot of flavors. And in this case, flavors for us might be a lot of money. Does this make any sense? Alright, and this is actually the major downside that I see. And that is also the reason why a dividend strategy for me personally is not my only strategy. Especially because I'm still in my wealth building phase. So I do not want to miss out on the growth of all of the other companies. And that's also one aspect, because we have these big mature companies that pay out the dividends from their profit, there usually is lower growth in those companies. And sometimes it's said that with a dividend strategy you have two types of profit. The one profit is the dividend that you get paid, and the other profit is the capital gain that you have when you sell the stock. Although I have to say that in my opinion, first of all, the main strategy of a dividend strategy is to get paid. Ideally, get paid for life. And so it would not be my goal to look at the capital gain of my dividend stocks or funds. But aside from that, there also may not be that much of a capital gain. Or if there is, it may be a small one. So I would not go for a dividend strategy if I would want to have a capital gain, if that makes any sense. And also in this context, what can happen is that the price of dividend stocks fluctuates a bit more. Because also each time the dividend gets paid, the stock price drops a little bit. And also because the profit is paid out to the shareholders, then this profit cannot be used for growth. So if you find yourself investing into dividend stocks and you look at the stock price and it makes you nervous, then this is not necessarily the best thing to look at. It's better to just look at your income. Another downside of a dividend strategy is that the dividend payments can be cut. So it's by no means a guarantee that if you buy stocks from a company that pays dividends, that they, for the rest of your life, pay that dividend and also increase it. That just comes with the territory. It's part of the market risk. And what's also maybe not directly a con, but something to keep in mind is the taxes that you pay on dividends. This depends on your country. In some countries it doesn't get taxed at all, in others it may be. Now the way I see it is that taxes are always part of the game of making money. Just for you to keep in mind that if there is a difference, in how your country taxes different investment strategies, then this might be something that you want to consider. And now, who is a dividend strategy for? I would say that depends on your individual situation, and it also depends on your financial goals. If, for example, you want a bit more stability and above all you want an income, you want that your portfolio directly pays you money, then absolutely go for it. Now, just in case you're wondering why I'm talking about stability, where I just mentioned that the stock price can fluctuate a bit more, if we still look at the big picture and we have these really big companies that have existed over 20 plus years, even when the stock price might fluctuate, that doesn't mean that the company is going anywhere in the next time. But still, these big, profitable, around for several decades companies are more stable, or let me say can be more stable than companies that are smaller or that are growing very fast and we just don't know what it's going to happen yet. Okay, so especially if you're someone who wants to see a cash flow, who wants to get paid, either right now or sometime in the future, that can be for retirement, either the regular retirement or an early retirement, then absolutely go for it. Even when you start right now and you don't need that money right now, as I mentioned, you can reinvest it and then benefit from the snowball effect. So make that portfolio bigger and bigger and bigger until you actually need it in retirement. Now, if you are young and or you want to build wealth like crazy, I would say a dividend strategy is less attractive. And that is because of this argument that I mentioned, that you're basically like blinding out a lot of the companies with a lot of growth potential. So if you want to maximize compound interest and growth, then you rather want to invest into the whole market. And maybe even taking on higher risk, because higher risk means higher potential return. And that is the exact reason why I at the moment also have the larger part of my portfolio into another strategy, so not in the dividend strategy. And if, for example, someone would ask me, who is already a millionaire, okay, how should I invest my money, maybe rearrange my money, that I could imagine to tell that someone to invest parts in a dividend strategy, because that way they can preserve their wealth and get paid at the same time. So if I had to categorize a dividend strategy on a scale, let me doodle that. So if I had to categorize the dividend strategy on a scale between building wealth and preserving wealth, it would probably be, I don't know, like rather here, dividend strategy. All right, so these are my thoughts about the dividend strategy. If you already have experience, would love to hear your thoughts and also the experiences that you made. Just again, real quick, the reminder, if you want to save your spot in my free web class, then click the link below. If you're still here, thank you for watching this far. I hope you got some value out of this. I wish you success. I also will link the playlist about investment strategies here, and hopefully see you in the next video. Bye-bye.